So, good afternoon, everyone. We are going to start our next session. Looking forward for our November exams. Okay. So, under financial market operations. Okay. So, under financial market operations, what are we going to see for this upcoming session? Okay, so before we move on to that, let's see what is the objective of learning this subject. Why do we need to know this subject in the first place? As a banker, as a financial professional, you need to be aware in which market you are operating in. You need to be aware about your environment first, correct? So this subject about financial market operations is there to give you the required knowledge, not only for you to pass the exam, but also to be aware about what's happening in the environment. Okay, it's not, I know ultimately you need to pass your exam, but there is life after exam as well. Okay, so as a professional who is focused on developing their careers, you need to know on what avenues you could be in touch, how you could gather further knowledge even after this 6 months time period of learning this subject. How can you harness that knowledge? That's what we are going to learn from this session. Okay. So these are the in detail titles or the chapters or the lectures that we are going to go through. In the very first lecture, so which would be today, we would be going through an introduction. Before we dip our legs into the pool, we need to know what's the depth of it, right? So first, it's an introduction. We see what a financial system is. And in that financial system, where is this financial market? And what is a financial market? And how has it developed? Then in the next lecture, we would look further in depth into what are the classifications of financial market. Is it just one market or are there subdivisions? If there are subdivisions, then on what basis are these markets divided? So our second lecture is going to focus on the different types of markets available and what are the similarities and the differences between them. Okay. Third one, fundamentals of financial markets, gives you a more of a theoretical foundation. Okay. What is this theory about? Now, we know broadly financial markets you could classify as debt and equity, very broadly. Okay. So one of the main variables in the debt market is interest rate. One of the main variables or main factor to be concerned in equity market is information. Okay, so we need to learn about the fundamentals behind these variables or behind these concepts. Okay, how can interest rate be decided? How can interest rate influence markets? Not only the debt market, interest rate also has an indirect influence on the equity market as well. So we will study that. Then looking at informational efficiency in a market. How important is information to a market is also learned in that particular lecture. So if you see the first 3 lectures that we will have is more about the background. We set the background or we set the environment before we get into individual financial markets. Then the heart of the subject lies in these 6 areas: money market, capital market, forex market, the structured financial products market, and the derivative market. Okay. So this forms the heart of the subject. We learn the background and now we get into the important areas. So first we will look at what money market is. Then we look into capital market. Capital market is a very broad subject that you could divide into debt and equity. Then we move on to the foreign exchange market. How is that's related to dollar against rupee? How is that being traded? What happens in that market? Who are the dealers? The terms we use in those markets, all those are covered there. And then we move into structured finance products. And now that is a contemporary market. What do you mean by contemporary market? Something that was added newly. Now, if you see about the conventional side, from early on, we had debt and equity. But with markets being developed, there were different financial needs that paved the way to the creation of structured finance product. So this structured finance product market is a new addition. Now, if you take Sri Lanka, be in the structured finance product, the usual products that you see in this market is you have securitization, then you have credit derivatives and so on. Certain products are very new to Sri Lanka. But if you take the international market space, those have been already there from 1960s and whatnot. Okay. And one of the essential or one of the biggest components of the structured finance products is the derivatives. So we focus into the derivative markets as well because there are several types of derivatives that we look into. In Sri Lanka, again, practically one type of derivatives that we always hear is forward contracts. But there are other derivatives that are being dealt in the international market. So you get an introduction of what those types of instruments are and how they are dealt. So this 6 is like the heart of your subject. And then now first we know the environment. First we know the heart, what types of market, what is happening in these markets. What market operations in these particular markets are being learned. And then finally, in the latter or the very closer to the end of the subject, we look into the financial market service providers. All these markets need certain service providers to support with their service. They can be informational providers, brokers, dealers. So we are going to learn about them in detail. So who are these intermediaries or these service providers who support these markets? And then we look into the crises that the financial markets have been through. Now that's not something new to you all. You would have heard about the 2008 global financial crisis, and just like that, there were financial crises even prior to that. So we learn about them. Why? Because there are important lessons to be learned. From those lessons, there are regulations being imposed, certain regulatory bodies that have come into place. So first, we look into what these crises are, how did these crises happen, and due to these crises, what are the consequences that the global or other global financial market or in specific Sri Lanka had to face. Then we move into the regulatory bodies that are available to protect the interest of the market participants. Who are these people? What is their role? And in which ways they are available to support the market participants. Then finally, we have recent financial market developments. Now, why have I put that as a very last lecture? Because that is then more closer to your exam. We get to cover even better topics. But remember, I don't push all the updates that's happening to the very last lecture. Whenever we talk about each week, when we have a topic to talk about, whatever that was latest occurrence relating to that market, we will discuss. Okay, but we will sum it all up at the very last so that you are aware about what has been happening practically as well. Okay, because if you look at the very last session that we did, which was the May 2021 session, they couldn't go for an exam. They did go through the entire lecture series, but when they are closer to the exam, we do have a revision session for them. So there we again discuss this recent financial market developments. Why? Because closer to the exam, there are further developments that has happened in the market. So if you're someone who are always intact, it's not something new for you. Okay. Now, for example, this is something that happened just 2 weeks ago. What is that? The stock exchange is introducing a new payment mechanism, delivery versus payment mechanism. So it's a new platform or a new method that is being introduced to the market instead of the older T+3 settlement policy. So the last session, the last session would have learned about the T+3 settlement mechanism. But now they need to be aware about this new development that is coming to the stock market as well. Okay, remember this particular subject that you're learning is a live subject. It's not something dormant. You can't just learn the theory, close the book and move it on. There are day-to-day occurrences that happen that you need to polish up and learn as well. Okay, so this was something that happened just few weeks ago. Delivery versus payment mechanisms that is coming in. We will learn this when we go through the stock market session. And then the latest occurring that is happening in the forex market. If you are a banker, you should be knowing what's happening in our foreign exchange market. Okay, the debt repayments the country has, what is happening in our forex market, is it how the exchange rates are moving, the pressure on the market and whatnot is something that you need to be aware about. Okay, so this is a new release that they had. It just came out. I think Friday evening it was out. Further regulations being placed to the forex market and on how when you're taking out forex out of the country, you have to abide by these regulations. So these are something new that is happening. So even those are interconnected to the forex market that you need to be aware about. Okay. So this is how your subject or your financial market operations for this session is structured. So these throughout this lecture series, this is how we will move. Okay, so today we would focus about the introductory phase. What is a financial market? Okay, so before we dig into what a financial market is, we need to know its background. So we cannot ignore the financial system when we start to study about financial markets. So we'll learn about what a financial system is and who are the different players in the financial system and where is this financial market connected. Okay, that's going to be our focus today. Now, throughout this lecture series, another thing that I want to emphasize is, this is something I do usually with my session. Once we move across from maybe the third lecture series, on a weekly basis, I send out questions for you all to attempt on your own and send it back to me. And that's something individual that I do through mail. Okay. So we will have about 5 MCQs and about 4 essay type questions. Why I do that is, while we journey through this session, I need to have a personal connection with you where I need to know where you stand, because MCQ tackling is a different strategy and essay question writing is a different strategy. The way you write is very important. You should write to the point, use the keywords for this session is very important. Okay, so that's something that I do with my students, and I know for a fact it has helped so many students, because Most of them wait till the end of the session or wait for the revision for them to do the past papers and learn how to write. But this is a weekly thing. Even if there are certain lapses, certain weeks that you can't do, I accommodate that as well. It's your discretion. I'm not saying you have to attempt it and get reply me back. If you want to improve yourself, if A grade is your target, because my focus is my students should target for an A, not even a B, look for an A. Okay, so my intention is to groom you for that. If you are willing to go for such a grade, you are always welcome. You could respond to that, do that question, or do those questions that I'm sending it to you and respond me back. I will go through them. I won't give you a grade or a mark. What I would do is I would read your answers. For MCQ, I will tell you, okay, if you did something correct, okay, this is the correct answer. And see, these other answers are wrong due to these reasons. I will tell you that. If you select the wrong answer again, I will tell you why the answer that you selected is wrong and how you should be thinking for this MCQ. If we go for essay question, you would have written out answer. Good. I will go through that and I'll tell you, look here, these matters are missing in your answer, and I will give you a suggested, look here, a proper answer for this question would be something like that. Okay, that's how I deal with my students. If you're interested, you could respond with your answers. Okay, that's something that we do from after the third lesson onwards. Then we have more areas to test on. Okay. So first lecture is Introduction to Financial System and Financial Markets. Now, what is financial system? Okay. Financial system is a very broad environment. Okay. It's a whole background, a whole landscape where you have several participants who involved to make up this system. Focus about the word system. When you say system in IT, you have input, process, output. Okay. Just like that, it has several components. Now, if you don't have a financial system, okay, if you don't have a mechanism to route funds, what will happen? If I am someone who's doing a job, I will earn my money, but I will have no place to park that money or to invest that money. Okay. If one of you is having an intention of opening up their own business, but you need money, if you don't have banks, nothing, how are you going to source that deficit or your borrowing requirement? Okay, so without a financial system, the components will have to work in isolation. Okay, I will have to find my own means to invest. There is no systematic approach. For you to find your borrowing requirement, your need to start up a business, you will approach your friends to borrow money. You know, your tighter circle is what you will approach for. But having a financial system benefits the country and the people as a whole. Why? Because that will give you the proper channel on how funds could move from the surplus units. What do you mean by surplus units? People who have excess money. That means you earn, yes, you get a salary, you have certain expenses that you need to meet for, good, but you have savings. That savings will get built up and you will fall into a surplus unit category. You have money that you could invest, okay, without using it for your expenses. Such people are allowed to route this surplus unit or excess funds towards the deficit unit. Now, who are these deficit unit? People who have more expenses than their income. What do you mean by more expenses? They might be wanting to start a business, certain big investments that they need to make. Also, it could be a vehicle requirement, a personal requirement, okay, but they don't have enough money. For them to get money, this financial system provides the channel. Okay, so as a whole, simply, why do we need financial systems? To channel funds from surplus units to the deficit unit. Okay, this is the diagram or the diagrammatic representation of a financial system as a whole. Okay, now here, first you will have, who are these people? They are the savers. They are the surplus units. You have certain households, you have excess money. You have certain business firms who save up. Okay, certain governments who has budget surpluses. Okay, certain foreigners with their savings. Okay, they all have excess funds than their requirement, and they want to earn an additional return from these savings. Okay, on the other side of the diagram, who do you see? You see the spenders. Now the spenders also are the same people, but can you see how the numbering has changed? For savers, you see a lot more savings coming from households than business firms, than government. Very rare. If you take our government, have we had a BOP surplus, a budget surplus? Okay, those kind of situation, very rare. So according to that, they have ranked. Spenders, if you take, who are the highest spending ones? You mostly have business or companies who have the highest fund requirement. They need more money. Why? They have investment needs, expansion needs. Okay. Then you have government, the development needs. Then you would find households, and very lastly, you might have foreigners coming in to borrow. Okay. Now these two are the extremes of this. Okay. Now, how do you connect these two extremes? Can you directly ask them to get in touch? You can't. Why? For a household, they might not be aware whether there is a business firm with such a need unless they have contacts. Okay. The household doesn't know whether the government has such a need. Okay. And think about the business firm angle. You might find one household with savings, but you might now, let's say you need 100 million, but you have one household with 1 million savings. You need to find 99 more, okay, with the same amount. So when you ask them to connect directly, it becomes difficult. But you can allow such direct communication to happen, but through a financial market. Can you see here? They don't directly connect, but it's through a financial market that this direct connection happens. Okay. What do they do? You have a market. Assume our stock market. Okay, let's talk a bit more practical. If you take our stock market, you have a lot of retail investors, you have a lot of institutional investors. Who are retail investors? Someone like you and me, if we have a CDS account, if we invest in the stock market, we are retail investors. Okay. Institutional investors are, let's say, insurance companies who have excess funds and who have a portfolio maintained. Okay. So these investors are there in the financial market already. So a business firm could approach the financial market, make an announcement saying, look here, I have a funding requirement of 100 million. I am giving you shares for that requirement. If you're willing, please invest. Okay. So through the financial market, these two parties directly connect. Okay. Now, even though that there is a financial market involved, you can see I'm using the word direct a lot. Why am I using that word direct? Because it is a platform that connects these two, not a intermediary person. Okay, it's not a bank which is connecting these two, it's a financial market that is connecting these two. A platform is connecting these two people. Okay, so that's why we call this kind of channeling, where funds move from excess units to the deficit unit through financial markets, is called direct finance. Okay, that is one way in which this channeling happens. Another way that this works, now here you could call it the first. Okay, another way this channeling could work is something that you already know. We get our salary. Where does the salary go? To our bank account. Now, when it goes to the bank account, it gets saved as a savings account. It gets parked in a bank. Okay, we just know that. All we know is, okay, my money is in the bank. But what does the bank do? They use this money and give it out to the deficit unit as loans and advances. Okay. We are aware about this bit only. We are not aware that my money has been used to give a loan to another company. I'm not aware about so much. I know my money is in a savings account. Whenever I want, I can withdraw. Okay. But you and I know in a bank, what do? Whatever money that we pool as deposit, we use it for our loans and advances, to lend out and loans and advances and get a return. Okay. So there you could see there is someone intermediary to this process. Yes, the surplus and the deficit units are connected, but they are connected through another person or an intermediary. It's not a platform. Now, understand the difference. In the first scenario, you are aware that you're putting money and this money is going to this firm, IPO, initial public offering. A business will come and request for this amount of money. You're aware about it and you put your money in that share. Okay. Here you park your funds in a bank and the bank use that funds for loans and advances. So that is called indirect finance, which is the second channeling method. Third method in which funds are channeled is also an indirect financing method. How does it work? The households approach the market intermediaries. Okay, they have the savings with the banks. The bank invests in financial markets, which in turn gives out the funds to the deficit units. What is a good example? Let's say you have dollar deposits in a bank. Okay, dollar deposits placed in a bank. Bank could use the dollar liquidity that they have and invest in Sri Lanka development bonds, which are dollar denominated. Okay, if a forex example is a bit more confusing too, let's go for a rupee example. So they might have certain rupee deposits with them. The bank could use these deposits to invest in treasury bills or bonds. Now, in a treasury bill or bond market, through that market, the money goes to the government. Okay, or let's take shares. Through the portfolio that the bank has, maybe it could go to a business firm. Now, this is not only a bank, it could be insurance as well. Think about an insurance company. You pay out your premium. That insurance company could accumulate the premium, invest in stocks and bonds, which in turn channels the money to the deficit unit, which could be ultimately the government or a business firm. Okay, so there are three ways in which this channeling happens, but on a broader way, it's through direct financing and indirect financing. So this as a whole creates your financial system. But there is more to that. A financial system doesn't only comprise of these components. Can you work in this particular environment without any regulations in place? No. So financial regulation is important to govern this in entirety. The entire setup, let it be direct finance or indirect finance, you need regulations to govern them all. Okay. And another one that I have included is the earlier diagram only had the fund movement. But remember, just like how you have funds flowing out, you have return coming the other way as well. For example, you and I have a savings account with the bank. So fund outflow to the bank is there. Funds are with the bank. Okay. Each month end, you and I will get interest from that, which is the return. Okay. You and I would be in the financial market, in the stock market, directly investing in stocks. If we get a dividend from that stock, it's a return to us. But let's say that company goes bankrupt. Then similarly, that risk is also passed to us. Remember, fund flow, the opposite direction of the fund flow is how the return and risk flow happens. Okay. So having understood that entire setup, what are the components in a financial system? Okay. What are the main important items or important variables that make up this financial system? Now, in this diagram, if you take this diagram, who are the important parties that we see? Yes, we see financial markets. Okay, we see financial intermediaries. Who are the others that make up these important components which make up this? Now, throughout these fund flows, remember, you can't draw the financial instruments, but you know, when you give out money, on the other way you get risk and return, and this risk and return comes by way of an instrument as a share or a bond. Okay, so financial instrument, though not explicitly shown in the diagram, is also important for a financial system. Can you have a financial system without markets? No. Can you have a financial system without financial intermediaries? No. You need both of them. Very true. But for these two to work, fund flow has to go through them. So when the fund flow is going through them, on the other way, a certain instrument has to go to the excess unit. Why? proof of investment. Okay. On the other end, for the deficit unit to raise funds, they need to give out an instrument, proof of borrowing. Okay. So financial instrument is in or embed in this diagram. So they form the third component. What is the other important component in this? Something that we have added later is the financial regulation. You can have all this, but can you operate without any regulation? No. If you do that, sometimes the excess unit can be exploited, sometimes the deficit unit can be exploited. For example, let's say there is no regulation in place. Then financial intermediaries can charge the any interest rate that they think of. Okay. Financial market can function in any way they want. If that happens, another party will be at a disadvantage. So to ensure that everyone is treated fairly and it's a fair flow of funds, you need regulation in place. Okay. So these four: financial markets, then you have the financial intermediaries, then you have the financial instruments, then you have financial regulation. These four are mandatory. That's why they form the primary component of a financial system. They have to be there in any financial system. Those are the primary components. But to support this primary component, so that these primary components work well, you need certain other variables as well. Financial service providers and financial market infrastructure. What are financial services, or who are financial service providers? News agencies, brokers, dealers, certain rating agencies. They support this financial system. We will know how they support through when we move through the lecture, but they provide added service. Service of information, service of awareness, service of convenience. Okay. So they are also an important part to a financial system, but they fall into the supportive category. Then you have financial market infrastructure. Now think about, we said financial markets are important for them to connect directly. True. But how is this platform available? There need to be an infrastructure for that. There need to be a payment mechanism to support this fund flow. All these are dealt by financial market infrastructure. Now, for example, yes, I have, let's say there's a savings account with D06. I have some money in that account. Okay. Now, I need to invest in X company's shares. Okay. I need to do a fund transfer. How can I do a fund transfer? Am I going to physically go withdraw my cash, go to the company and give them the cash? If it's 10 rupees, 20 rupees, okay. But what if it's in millions? So as a support given to the financial system, you have payment mechanisms, slips, RTGS, check realizer, check image and truncation system. All those are available as a supportive component to the financial market. Okay. Now remember, these components, they don't operate in isolation. They are always connected. Okay. How I want you to understand the gravity or how these are interconnected, because think about just one transaction that you do. Okay. In the I would have elaborated all these in the note as well. Now think about just one transaction that you do. You are buying shares of some company. Okay. Now to make sure everyone is connected, it's not an IPO, but let's assume that you are going through a broker. Okay. So there you have what is the financial market that you're going to deal with? The stock market. Okay. Who are you going through? Who is your intermediary? You have to have a broker. Okay. So you come through your stock broker. And what is the instrument that you're buying? Shares. Who is the regulator? Who is imposing all these regulations overlooking these purchases? You have the Securities and Exchange Commission. Who are the financial service providers? Stockbroker, analyst. A broker falls in both categories. Why? Broker gives you information as well. If you are practically aware, when you go to buy a share, they don't just put the bid for you. Okay, they will also tell, if you say, okay, let's buy this company share, the broker will say, no, that share is not recommended, let's go for something else. Those kind of support services, the information that they provide. I hear that company is not doing well, their financials were not good, the earnings per share was not good, they reported a loss. Okay, those informational services are provided by the stock brokering firms when you deal with them. Okay, then you have certain analysts giving out reports and whatnot. So those are the financial services that will support your decision in whether to buy that share or not. Okay, finally, when you're doing the payment, when you're paying for the share, it has to come through any of the payment system. It can be SWIFT, it can be slips or RTGS. According to the quantum, of course, the payment system will work, and your central depository, your CDS account will get updated for the new purchase, having a record about what shares you purchased. Okay, so you can see all these 6 components are working together so that one transaction goes through. Okay. Now we are going to get into details of these 6 components. What are these 6 components and what are the importance of what functions are these intermediate or what functions are these components doing in the financial system? Okay. The very first and important one, financial intermediaries. Okay, financial intermediaries are usually finance entities. They usually take a form of a business entity. What do they do? Their main function is financial intermediation. What do you mean by that? Again, they take funds from surplus units and move to deficit unit. Look at the diagram here. You can see the main role, pool funds from excess and give funds for the deficit unit. Financial intermediation is what the technical term that you use for that. Okay, to do that function, you have financial intermediaries giving you the required support. Now, if you take financial intermediaries, you can broadly divide them as deposit-taking institution and non-deposit-taking institution. Now, when you think about the word deposit-taking institution or depository institution, what is the first institution that comes into your mind? Of course, the banks. It can be licensed commercial banks or licensed specialized banks. Okay, there you have banks who take deposits from the general public and use these deposits to give out as loans and advances. Not only them, you even have finance companies who are authorized to take fixed deposits. Okay, all these will fall into the depository institution category. Any institution who are authorized to accept deposits fall under depository institution. Why? Because their main source of liquidity, their main source of bringing in money to the company is through deposits. Okay, so for such institution, they fall into the depository institution category. Then you have non-depository institutions. What are these non-depository institutions? You have certain financial intermediaries who don't accept deposits, but they get their money by selling securities, by selling financial securities, or by accepting contractual savings. So according to these two types, you can further categorize non-depository institutions to contractual saving institutions and investment intermediaries. The very first subcategory, contractual saving institutions. Who are contractual saving institutions? First, think about an example. Your EPF that is being paid out. It's a contractual saving. It's an obligation. Every month, there is a contribution made. Okay. Think about insurance companies. Every month, you pay out your premium. Okay. So, it's a contractual amount that you pay for that intermediary. That particular intermediary accepts that payment that happens on a periodic basis. So, on a monthly basis also, they accept that amount and that will form their liquidity, or that will form their funding line. Okay. Why are we not using the term deposits here? Deposits meaning you deposit with the intention to withdraw any time. Okay. Or withdraw in the reasonable time. But here, contractual savings, your withdrawal is restricted. There will be a particular conditions in which you could withdraw. Think about EPF, certain age category or certain specific conditions in which you could withdraw. If not, withdrawals are not allowed. Okay. So that's why this falls into the contractual saving institutions. Now these institutions, managing funds for them is very much easier. Why? Because they know they can predict the withdrawals they will have for a year. For a bank, who let's say something like Bank of Ceylon, they have a very good network, but I think the largest network is by People's Bank. They have the highest branches. So let's take something like People's Bank. So many branches, they can guess the amount of withdrawals coming through their past withdrawals, but that withdrawal quantity is very high. Why? It's a savings account. It's a current account. People are allowed to withdraw anytime. Okay. But EPF, or let's say insurance, they can't withdraw anytime. They know once they attain the age of 55 or once they have a particular condition is where they could withdraw. Okay. So these institutions, contractual savings institutions, can always predict their withdrawal, okay, with reasonable certainty. So they can allocate only that amount and invest the balance amount as long-term investments. Okay, they don't have to have a larger portion in the short-term investment. Why? Because they can reasonably predict this is the maximum withdrawal they will have for this year. Okay, so this gives these institutions the advantage of investing in long-term assets. Okay, That's a very important feature when it comes to contractual savings. That's why you have pension funds, trust funds investing in a lot of shares, treasury bonds, long-term debentures and everything. Okay, that's because they have that ability to do so due to the predictability of their withdrawals. Okay, then you have investment intermediaries. Now, investment intermediaries are very much different than contractual saving institutions. Why? Do they have any contractual amount coming every month? No. But they earn their money, or they attract the liquidity or mobilize their fund requirement by sale of instruments. A good example for sale of instruments is unit trust. A unit trust has units that they sell to their investors. So the investors can buy the unit, give the money to the unit trust, and the unit trust in turn will invest that amount in stocks and bonds and earn a return for their investors. Okay, that's what they do. Through sale of securities, or by accommodating or facilitating that process, brokering firms, investment banks can earn commissions, and this will create them the funding line. Microfinance companies, they usually get their money through commercial papers, securitization processes, where they create the financial instrument with the support of another investment bank. They create these financial instruments, sell it, and get the required cash for their further investment. Okay, they will fall under the investment intermediaries category. All right. Now, what are the functions that these financial intermediaries do? The first two are very obvious. The very first function is they are bestowed or have that duty to obtain funds from their surplus units. They accept deposits, they take contractual amounts. Through that, they mobilize the funds. Okay. Secondly, such mobilized funds are invested in the deficit unit. They give it out as loans and advances, or they invest in the shares and bonds of these deficit units, and through that they channel the funds. Okay. And another function that they have, which is the most important function, is asset transformation. They have the ability to transform asset from a high risky to a safer asset, from a short term to a long term asset. Okay, so that transformation happens through financial intermediaries. Now, for example, you will have your salary savings in a savings account. That is your asset. Okay. Now, the bank can use that short-term asset and give it out, let's say, use that money when they give out a housing loan. So, it's a long-term asset to the bank. Okay. So, they do the maturity intimidation. Okay. Sorry, intermediation. They do the maturity intermediation. They turn the short-term asset into a long-term asset. Okay. Due to their intermediation. Secondly, you can have certain risky assets. For example, a company, let's say a microfinance company or a leasing company, has given out certain leasing, okay, leasing facilities. Now those are very high risk leasing facilities, and now they want to mobilize that and transform that and get some cash. In other words, they need to engage in securitization. Now, that's a word that you will learn when we go for structured finance product in detail. So through securitization, the financial intermediary will help the microfinance company or the leasing company to transform high risk asset to a low risk form, which will help them to diversify and reduce risk. Okay. Finally, cost reduction. Because of their intermediation in this transformation, they are able to reduce the transaction cost and the information processing cost. Now, if you have to find and do on your own, it becomes very, very difficult. Okay. But because a bank is involved, they facilitate this process, which makes it low cost. Okay. Now the first three are more of the functions of depository institutions. Okay. Next few are more for the non-depository institutions. Okay. Facilitating the trading of financial assets for customers through brokering arrangements. So your customer would have certain assets that they need to trade for. This institution or this intermediary can act as a broker and facilitate that trading. Okay. Facilitating the trading of financial assets using financial intermediaries' own funds to take a position in a financial asset that the financial intermediary's customer wants to transact in. Now, don't get confused. Okay. Why is it so elaborate? Because this word could be new to you. Margin trading. Margin trading is something that you will learn when we go to the topic of stock market. But that's another function that these financial intermediaries do. What do they do? Let's say I am a customer and one of you is the financial intermediary. Now I want to buy X company's shares. Okay, but I don't have money. I approach you, I tell them, look here, I want to buy X company shares because I feel X company shares are going to do well. I can get a good return. Okay, but I don't have money. As a financial intermediary, you will support and facilitate my transaction. How? Using your own funds. Financial intermediary will have some funds. Using that funds, you will buy X company's shares so that you can give it to me. Okay. So I am able to buy X company's shares through my intermediary's money. Now remember, financial intermediaries don't just buy and give out of pity or out of humanity. No, there is all return, borrowing involved. I am taking their money, which means I have to give them interest for that. Okay, so it's a borrowing involved, margin trading. What is the security that they get? The share that I'm buying, even though I own it, it is ultimately to the bank or the intermediary that is involved. They will pledge that stock for them. In case I am unable to honor, they will sell that share and get their money. Okay, so that's a concept of margin trading. So what do they do in that? They help their customer to take a position in a financial asset. Let's example is buy a share using their own money so that the customer will get the opportunity to buy that stock and get the desired return, even though they don't have money with them. Okay. assisting in the creation of financial assets for its customers. Then either distributing those financial assets to, sorry, you can cut the word either here if there is an error. Then distributing those financial assets to other market participants. Examples, commercial papers and securitizations. Again, here I told you, a leasing company can approach a bank asking help. Look here, I have certain risky assets. I need to transform them. My money is tied up in these leasing facilities. I need that money out. I need a new funding line. Can you help me restructure this? So they will issue or create a new financial asset using the process of securitization, and the bank themselves will market that asset. Look here, commercial paper of this company is available. There is a asset mortgage backed liability asset that is available. Why don't you invest in that? Okay, they do the roadshow and collect the pool for their customers. Okay, that's another function that they do. Finally, providing investment advice to their customers and manage the financial assets of their customers is also another function that most financial intermediaries do for their customers. Okay, if you take brokers and dealers, like what I told you, they provide the advice. If you come up and say, look, I want to buy this company share at this price, they will say, no, this company hasn't gone up to this price ever. This is an abnormal price. Let's wait and see. It will come down further. Those kind of investment advice. Or they might even say, no, don't go for this company. The reports are not good. Analysts are not recommending this share. Okay. They could support the customer through advice. Not only investment advice, sometimes in business advice. If you have certain companies going out for major expansion, the bank or the financial intermediary could use their expertise because they must have dealt these projects earlier. They could advise the customer, look here, why don't you look into this avenue? Why don't you do this? Why don't you get this approval, which is important? Okay, sometimes you might get an issue after that. Okay, those kind of advices financial intermediaries do provide to their customers. Another is safe custody of their financial assets. Certain stocks and bonds that they invest in could be managed, or it could be entrusted to the financial intermediary so that they could safeguard them as well. Okay. Next, you have financial instruments. Now, financial instruments, I told you, in a diagram, we are unable to explicitly show them. But in a fund movement, they are always there. If I am giving money to invest in a share, on the other hand, I am getting that share. Okay. If I'm investing in a bond, on the other hand, I am getting that bond. My money is going out of me, I will get a bond. Okay. But what is this financial instrument? Okay. We call several items as financial instruments. What do you need to have so that it can be called as a financial instrument? Financial instruments are intangible assets. You're unable to see them physically. Okay. But this instrument is expected to bring you future benefit in the form of future cash. Now remember, the key word here is expected to provide future benefits in the form of future cash. Why do we use the word expected? Think about the word, think about shares as an instrument. Okay. Today I buy that share at 10 rupees. What is my expectation? Look here, if I buy at 10 rupees, this share will move up to higher than 10 rupees and give me future cash. That is what I'm expecting. But it could always go down further. It could go up to 8 rupees and get me a loss as well. But expectation is to get you future benefits. Okay. So some of you call these financial instruments sometimes as securities, and generally it includes stocks and bonds. Okay. Now, when you're going to trade or transact in an instrument, you bare minimum you will see two parties in that transaction. One is the issuer, other is the investor. Okay. Who is the issuer? Issuer is the person who is releasing this financial instrument, or who is issuing this financial instrument for sale. They will say, look here, I am selling my shares at 10 rupees. Issuer. Now remember, the word issuer is important because here the instrument gets issued for the first time. Most of the time students confuse the term issuer with a trader. Okay. Think about the initial public offering. What do you mean by initial public offering? For the very first time, a stock is issued to the market. Okay. Let's now, what is the recent stock issuance that our market had? Prime lands. This is a recent listing that they had. You can see the prospectus just came out in June. I think another company that is expected to be listed is Jet. Yeah, you have the single finance debentures. And I think Jet Holdings is another expected company to come in for IPO. So Prime Lands, you can see this is the IPO. This is a prospectus that they issue initial public offering. Okay. So this is the first time that their share is being issued. Okay. So for 10 rupees and 40 cents. So they are the issuer. They issue the financial instrument for sale and they agree to make future cash payments. For a share, it is dividends. They promise for dividend. Okay. So they are the issuers. Investors or parties like you and myself who invest in that share so that that instrument will be owned by us and we pay out money for that. By doing this, we will have the right for dividends, or we will have the right to receive the cash inflows coming from that financial instrument. Okay, so you have issuer and investors. Who is a trader? Someone who bought the share and now is trying to sell. It's not the issuing company. It could be someone like myself. Let's say Prime Land is issuing. I invested in Prime Lands, bought that company share. Now I want to sell it to someone else. Okay. So then do I become an issuer? No, I didn't issue this share. I just invested. Now I'm going to sell. I'm a trader. Okay. I'm trading in the stock market. All right. So issuer and a trader are different. Another way that I could show it to you is, now here you could see what is the issue price? 10.4. But now you can see What's the price that it was getting traded in the market? 10.2. With a 20 cents loss, it's being traded in the market. Okay, so currently traders are selling it at a lower price. Okay, so if you buy now, you become an investor having claimed the future dividends. Why do you invest? Why do you put money in financial instruments? Because we have a desire to earn a return. We want to get more money. We have savings, yes. So why don't we just keep that savings as it is? We want to get additional, earn a return without just idling funds. Okay. Now this word return comprises of two components. A return can come in two ways. Example, you buy a house. Okay. You buy a house, but you're not going to live in that house. You rent out that house. Okay. You bought that house, let's assume for 1 million. Okay. And now you have rent out that house for 10,000. Okay. What is the periodic return that you have? While you own that house, you get 10,000 as your rental income. As long as you own that house, you will get 10,000 as your return. Okay. But when you sell that house in another 3 years, will you sell again at 1 million, the price you bought itself? That time the market price would have definitely increased. You can sell it for 3 million. Now you have a return of 2 million that you bought at 1. Now you are going to sell at 3 million. You have a 2 million return. Now you could see that 10,000 rupees that you received monthly was also returned. That 2 million that you earn when you sell that house is also a return. But it's called a specific name. While you own an asset or while you own an investment, if you get income from that, you call that yield. Okay. As long as you have that investment, you will get it. When you sell that investment, you won't get it. If you sell the house, can you still get rent? No. Okay. But the other type, when you sell off that investment, you will get some return, I told you. That is called capital gain. That return is realized only at the time of selling your investment. Okay. So return has two components, yield and capital gain. Yield is as long as you hold that investment, you will get that income. Capital gain is at the time of selling that investment, you will realize that increase in the value of investment. Okay. So these two are the two components or two ways in which return can be earned. Now, why do we need to be aware about it? Let's take a stock, a share. I bought the share, let's say at 10 rupees. Whenever they declare a dividend, let's say here, they have declared a dividend of 40 cents. Okay. So 40 cents is a dividend I earn when I have this share. Okay. Let's say I don't want this, I quickly sell off. I only get this 20 cents. Okay. So if you sell it, this is the return that you get. If you hold on, you will continue to receive this dividend. Why do you need to be aware about these two? Because depending on what return that you prefer, your investment decision will change. Okay. For example, if I want to buy a house and get capital gain as my return, then my focus is about getting a house in a good area where the value will appreciate quickly. Okay. Again, I'll repeat. If my intention for buying a house and earning a return is that, okay, I buy a good house, I can sell it at a very higher price in a shorter time, then I will look to buy a house in a very residential area where the prices escalate very high. Okay. If my focus is about getting a rental income, then I won't be bothered about that. Then I will look to invest in a house which is higher, where I can have more rooms to be rented out and earn a good return. So your investment decision will get affected about based on which return you want. Very good example again when it comes to shares is certain shares don't pay dividend at all. Okay. For those shares, an investor would step into that share only if the capital gain is very high. Okay. But there could be some other stocks, you call them dividend stocks. Those stocks give out very high dividends. So dividends is something that you look for. You will definitely go for those dividends or high dividend paying stocks. Okay. So the return, you need to understand why, because that return creates or affects your investment decision. Okay. Financial instrument. What is the function of this financial instrument? The very first one is they allow this fund movement. I am willing to give you money because you are willing to sell me the share. Okay. So for that fund movement, to allow that transfer of funds, financial instruments is important. Okay. Other is to redistribute the risk. Why? Example, let's say, okay, let's not get into a practical example. Let's say X company is issuing shares. Why are they issuing shares? They want to put up a new factory, a new ice cream factory. Okay, they want to put up a new ice cream factory next month. Okay, for that they need money. For that they are issuing shares. So to allow the transfer of funds, you issue shares. Shares are given out to the investors and the company will get money. Good. Now what happens? The return, whenever if the ice cream company does well, the return will go to the investors in the form of good dividends. Let's say due to COVID, no one is buying ice cream because they're scared they will fall sick. No one wants to get into it. Then losses. Who is going to bear that loss? Obviously company, yes. But ultimately the shareholders. Why? No dividends. When it's losses, other investors are scared to buy this share as well. So they are unable to sell the share at the high price that they bought in. Now the price will be very low. Okay. So first, that risk was only with the company. If the ice cream factory fails, company also fails. But now they have redistributed the risk. They have transferred the risk. It's not a unfair thing to do. The shareholders are aware, look here, they are aware when this project, if they perform well, I get a return. If they don't perform well, I get a loss. Knowing that, they enter into this. Remember, high risk, high return. Okay, that's the premise when it comes to investment. So knowing that, they are willing to take up that risk. So to redistribute that risk, financial instrument acts as the vehicle. Next, financial regulation. Financial regulation is important so that someone is available to monitor unfair, misleading practices which hamper and affect the market sentiments. Example, let's say we are all investing in a certain instrument. Okay, a certain company is issuing a share, we are all investing in that, and all of a sudden that company runs away with that money. We all lose the money that we invested. Okay, what happens? We all lose confidence over the financial system. We are scared to invest further. Okay, then I will tell my close associates, look here, I got affected, you all also don't put the money. This bad experience will have rippling effect, because then people will be scared to come forward and invest through the formal methods. Okay, this will obstruct efficient flow of funds. If I don't come in, I am an excess unit, but I'm scared that other party will cheat me. Therefore, I don't want to come and put my money here. Then the excess units will be reducing. Then can proper fund channeling happen? No. Okay. So you need financial regulation so that the confidence in the financial system is not affected. Okay. What are the other reasons that you have? That's the main objective of having financial regulations. What are the other in detail reasons that you have? First one, market participants are treated fairly, so that there are no any unfair or fraudulent practices in the market. To ensure that, you need financial regulation. If you were aware about the financial news that were happening this past week, this is something that you could easily relate to. What happened in this week? You would have seen the LOLC stock got a very high hype. You can see here, regulators watching LOLC Development Finance PLC's meteoric rise to fame in no time. Again, this is something that attracted the view or the attention of the regulators. Why? There were so many complaints of mismanagement. There could be a certain pump and a dump strategy being used here. You know, quickly the share price increases, then again it crashes. Okay, it's an illegal thing to do. Okay, it affects mostly the retail investors who are not aware about this. Okay, the participants who are aware about the market are safer. It creates an unfair situation. Okay, now if I am someone who has been dealing in the stock market for a long time, I would know, look here, this company has not moved above than this. There is no reason for it to move above than that. So let it rise, I won't touch it. Okay. But if you are a new investor who wants to earn quick money, you will see, oh my God, this share is skyrocketing. Why don't I invest today and sell tomorrow for a much higher price? And if you get at the wrong time, you will lose all your investment. Okay, so it affects, or it's unfair treatment to most of the investors. To prevent that, regulators need to involve. Now here, if you see this article, you can see end of May share price was 73 rupees, but end of June it was 618. So see the increase in just 1 month. If you just put 73, you got 600 rupees by June. Okay. This is a very quick increase. Now, what you need to know is such an increase can happen if there are fundamental reasons. Let's say the company says they are going for an expansion. Let's say the company has got another big order. Okay, when such a positive news comes in, share price skyrocketing as this can be warranted. But when there are no news as that, something like this happening is very fishy, right? The company has no new news, nothing, but all of a sudden price increasing is something that you need to watch about. Okay. Now, when this news came in that the regulators are, watching over this price, you can see the price coming down. See, this is as at yesterday, the price had come down. Previously, it was at 500. They've been declining slowly. Okay. So to prevent this, you need regulators to ensure disclosure of accurate information for investment decision making. Why? Certain investors shouldn't be given priority where they are given access to certain information and others are not. Okay. The financial regulators should have in mind whenever there is information to be given out, the issuers or the parties involved should disclose it at one time to everyone. So everyone gets to have the same time for their decision making. I can't give you the questions, I can't give you the news 1 month early and you 1 day early. Okay, because you have more time to research and make your decision, but the other person only has 1 day. It's unfair. Okay, so to avoid this, to avoid information not being given out correctly or inaccurate information given out, you need regulations in place. Now, because we have regulations in place is why companies make this kind of a statement because Securities and Exchange Commission ask the particular company, look here, your share price is skyrocketing. Is any of your information being leaked out that the others don't know? Okay, give out a press release for that. Here you can see, we refer to your letter dated this day by the head of trading. According to this section of the listing rules, we confirm that there is no undisclosed price sensitive information that is with the company. Okay, they give out that they say, look here, there is nothing that there is no price sensitive information that is withheld by us. They disclose that, they confirm that to the company. Okay, so that provides or that clears the air. Why? Because sometimes unknown investor would be thinking maybe the company is going to do something, that's why it's increasing so high. Okay, so that doubt or that speculation is cleared out when the company releases such a statement. When they say, look here, there is no undisclosed information with us for such a occurrence to happen. Okay, this is the example of us having a regulation, and because of that, these press releases are being asked to given out to the public so they can clear out any unknown speculations. Okay. Finally, why do you need regulation? To ensure the financial system is robust and it's sound. Not only the financial system, but also its intermediaries are strong enough to absorb shocks. Okay. What is the example that will come to your mind when I say that? Basel III. You have that regulation so that you can further improve the strength of the financial system and the intermediaries. Okay. These are the recent major regulations that are being in place. So in 2000, with the Enron bankruptcy and the world.com bankruptcy coming in, there was a dot-com bust. A lot of IT companies being mismanaged, going into bankruptcy. So in that particular time, Sarbanes and Oxley Act was introduced, and it was a main catalyst or a major milestone when it comes to corporate governance. That term corporate governance got its prominence from this Sarbanes and Oxley Act. Okay. Then another major crisis that the entire globe had to go through was the global financial crisis that led to the US Wall Street Reform and Consumer Protection Act. Simply, they would call that the Dodd-Frank Act because it was based on their recommendation. Why? They recommended or they regulated, they tightened regulations for financial markets and intermediaries, and certain regulations were put forward to protect consumers so that financial intermediaries don't push high risk assets to consumers. Okay, so to govern those areas, the US Wall Street Reform and Consumer Protection Act was introduced. And another result of the global finance crisis was Basel III. The global financial crisis in 2008 highlighted the limitations of Basel II, because Basel II focused on the quantity of equity only. But in Basel III, it brought out the need to look at not only the quantity of equity, but the quality of equity. Whether you have the tier 1 capital, whether that is adequate, the composition within the total equity are of a good composition. Those are focused in Basel III. And not only that, whether you have stable liquidity funding to face liquidity shocks is also assessed in Basel III. So those regulations came about in the global financial crisis. Then we move to financial service providers. So these are the financial service providers that we will be looking at when we move to that lesson. Brokers and dealers, how different they are, why are they different, the functions that they do, and the return that they earn. Always remember, even though in conversation, in practical world, when we talk about a broker and a dealer, we might be using the word interchangeably. But a broker is very different from a dealer. Broker is someone who will make the seller and the buyer meet. That's their only job. Dealer is someone who takes a position in that asset. If I'm explaining to you very plainly, what I could say is, again, think about a house. If there is a house for sale and the seller doesn't know to approach the buyer or doesn't have enough buyers, a broker will intervene and say, okay, I will get you some buyers. So the broker will market, okay, there's a house like that. They will collect some buyers and bring for the seller to show the house and pick out some person who would buy that house. Okay, that's the duty of a broker. But a dealer is someone who takes a position in that asset. If the dealer gets to know that there is a seller who's willing to sell this house, the dealer will buy that house. Okay, takes a position in that asset. They will buy that house, transform that house, okay, and then resell it. So for a broker, the return is commission by making the seller and the buyer meet. But for a dealer, the return is profit. Difference between the selling and the buying price. Okay, that's the basic difference between these two. Then you have research companies. Research companies, what do they do in a financial market? They analyze listed companies, they analyze financial instruments, and they give out recommendations. When we move to that lesson, I will show you certain reports that they do for you to understand it better. They go through a company and say whether to buy that particular company's shares, whether to hold that company's shares if you already have, or whether to sell that company's shares currently. Okay, then you have rating agencies. Rating agencies giving you out information about what's happening in the market, what's happening in the country, okay, to influence your decision making. If you were aware about what's happening last week, you should have been aware about the Fitch ratings comment about our bank, about with the forex risk that is coming into with the forex risk impacting our sovereign nation. Because any of the banks who have high exposure to government instruments face a higher risk, is what they say. Okay, read out this article, very, very, very important. You could see if such a risk materializes, you could see this dash shows the minimum common equity ratio that we need to adhere for each bank. If the risk materializes, what banks face the highest risk? Okay, so they give out these investments so that investors can guide their decision making according to this. Okay, if you are an investor who holds shares of these banks, you will be worried by now whether to reshuffle your portfolio. If you were someone who was going to invest in these banks, you will rethink again. Okay, so they provide these support services by giving out these information, these analysis. Okay, credit bureaus giving out credit information about borrowers to banks. Then you have other information providers such as Bloomberg and Reuters who give real-time information. Now this is mainly used by treasury units of banks who have access to ready information. Then you have press and media through journals, through newspapers such as Economist, Wall Street, and Financial Times. Even locally, one of the good places that you could be aware about the financial occurrences is Economy Next, Lanka Business Online. Those are certain news outlets that gives you this financial information on a regular basis, so you could be in touch. Okay, so what do they do? The main contribution or the main function that the financial service providers give is the support to the decision making process. They provide the convenience or they provide the information needed for you to make your decision. Okay, then you have financial market infrastructure. What is financial market infrastructure? It is a system, it's a platform, as I told you before. If it's a platform, who are the people who could involve in this platform? Can everyone be involved in this? No. It is the participating financial instruments and the operator of the system who will get involved. Okay, not everybody. Now, why am I saying that? Don't get confused. Yes, we use the payment platform. We use the payment platform, but it is the banks that are participating in that platform. They have the transaction going out through them. So it's the banks and the operator of that system who are working in this multilateral system. What do they use this system for? They use to record, clear, settle payments, securities, any other financial transaction using this infrastructure platform. Now, what is the objective of having financial market infrastructure. Example of financial market infrastructure is the payment platforms. Okay, why do you need payment platform? The very first one is so that you could quickly do your transactions. Very good. Yes, quick is something that you want to do. You want to quickly do your transaction without having to go to a branch, wait and do it. Okay, but think about the safety. Safety is another concern. Now you and I would be doing internet banking, mobile banking, everything. It's easy, efficient, but we are always focused about safety. If that platform is not a safe platform, will you and I be in that platform even though it's a faster platform? No. So when it comes to financial market infrastructure, safety and efficiency needs to be balanced. You can't have a safe infrastructure or safe system, but it takes about 2 hours to do a transaction. No. You can't have the most efficient system which will do a transaction in a second or 2 seconds, but that system is not safe. Your information can get leaked out, then nobody will use that platform. Okay, so there is a need to balance these two objectives. When it comes to safety, how you could tackle or how a financial intermediary could tackle is they need to analyze the system and first see the ways in which the safety threats or the risks that come in. Through what sources can these risks materialize? Whether it's a technological risk, whether it can crash, somebody hack, okay, those avenues. Or it's a legal issue. Can somebody raise a legal case in this? Or whether it's an operational risk. Can the system go down, collapse? Whether it can time out. Okay. Those sources need to be addressed, identified, and then you need to assess such source to address and answer for that. Okay, that's how you tackle safety. Efficiency is how quickly you could do the transaction and how consistently can you do that transaction. If I can do one transaction in 2 hours, in 2 seconds, and the other transaction in 2 hours, is it efficient? No. For it to be efficient, it need to be timely and it need to be consistent. Okay, the deliverable should be timely and consistent for you to effect that financial transactions. Okay, so these are the main payment clearing and settlement systems of Sri Lanka. We have the check image and truncation system through Lanka Clear, where if you deposit an interbank check, if you have an NTB check and deposit it in D06 account, it will take the next working day for it to be realized. Okay, that's the most quickest. Earlier it took nearly 7 days, very early on. Okay, now it has improved so far for just T+1 basis. T+1 meaning the day you do the transaction to the very next day, next working day. Okay, so if I deposit it today, the next working day I will get the funds. If it's an interbank check, if it's the same bank check, then the same day I will get the credit. Okay, then you have slips, Sri Lanka interbank payment system, allowing you to do the low value payments, usually below 5 million. Now here it's not a real-time system. It's a platform. It's a timed platform. You have certain cutoff or certain cycles in which the payment system will run. Okay. But if you want to do a payment real-time and it's a high value, you would definitely do through real-time gross settlement system, RTGS system. And now you have common electronic fund transfer switch, CEFS, okay, CEFT system, which is online and real time. It doesn't get impacted whether it's a holiday or anything. Even during the non-banking hours, you are able to do your transaction. Okay, this is a major development that paved the way so the transactions can be done through ATMs, mobile phones, and internet. Okay. Now we saw all the other components, and now we come to the major focus or the focus of our subject, financial market. What is a market? Market is where two or more people engage to exchange something. Somebody gives a good or service, from the other end you get the fund related to that. Okay, so there are two parties definitely involved, a seller and a buyer. Okay, so they sell the good in exchange for money. Okay, so financial market is no different. Here also, it's a platform where two parties meet, two categories of parties meet. Bare minimum, you will have two parties. Okay, the minimum. What do? They exchange. Do they exchange goods and services? No, they exchange financial instruments. And to exchange financial instrument, fund flow has to happen through the market. Okay, so financial market is there to facilitate fund flow for the exchange of financial instruments. Financial market is the market for credit, which is debt, or market for capital or equity as well. Okay, here you have ability to source money from debt sources and from equity sources. Okay, so throughout this system, throughout the financial system, we now know financial market is only a component of the entire financial system. Okay, there are other parties as well, but financial market is just one component of it. Okay, why do you need financial market? Can you work without financial markets? You think about an environment where you don't have financial markets. As I told you before, you get salary, you have your savings with you. Okay. Now, if you need to invest somewhere, you need to approach or you need to use your own contacts and find ways to invest. Okay, it has a cost from your end. You have to do your research and everything. Okay, now let's say you need money. Okay, you need money, some additional money. If you ask from your next door neighbor, he will say, okay, I can give, but 16% interest. Because you don't have a wider platform to go and ask for money, you might have to settle down for that high interest. Okay. Another example, you have a house to sell. Okay. Or any other financial instrument to sell. But you don't have a market for that. There is no one particular platform where you can sell this instrument. So what do? You call up and tell your friends, I have something like this, I'm willing to sell, do you want to buy? Then obviously they will bargain. One will say, no, it's not worth that much, I can only buy for 100 rupees. Other one will say, I will give you 500. Other one will say 200. So you don't have a consistent number. But if you have a financial market, what happens? There are so many buyers and there are so many sellers. One seller can't artificially increase the price, at least not for long. One buyer can't decrease the price either. There is a market norm. Now this will create something called liquidity. What do you mean by liquidity? The ability to sell an asset at the market value at any time. If you have a proper functioning market, I can sell my financial instrument anytime at the current market price. Let's say there is no such market, then I have to go in search of the buyers. Then the buyers will bargain. Therefore, I won't get the market value. I will get something lesser than that. And can I get the money at any time? No. It's going to take a very long time. Okay. So liquidity is one of the major functions when it comes to financial market. Other one is price discovery or setting. Now, when you have so many buyers and sellers, you know the relative market price of this product or this instrument. You know, okay, it is at this price that these two parties are willing to contract. So that creates a market value. For example, if you look at this particular stock, you could see, okay, 10.2 is a price that the buyers and sellers are willing to pay for this share. So if I sell at 14 rupees, it's going to take a long time because market value is this. If I want to buy at 8 rupees, it's going to take a long time because market price is this. How is this market price determined? Because in the market, in the financial market, the buyers and sellers have interacted and have discovered the price at 10.2. Okay, so this asset has a price. So because you have a financial market, you're able to identify that price. Okay, through this price discovery, it also gives another benefit where you are able to value that asset. Now, if one share of this company is 10.2 rupees, what is the value of this particular company? You can multiply the shares of that company by 10.2 to know the entire worth of this company. Okay, so for you to value an asset, that price discovery is going to help it. Okay, what's the other function of a financial market? Raising capital. Deficit units can always come to this financial market and raise the required capital for their requirements. If it's for the deficit unit, think about the excess unit. Excess unit can approach this financial market and invest their money directly to the deficit unit. So for investing purposes as well, financial market creates the avenue. Then you have risk management. What do you mean by risk management? Because it is a financial market, where you will have several buyers and sellers, you are able to sell the risky asset quickly and buy an asset which is of low risk. Okay, you can manage your risk appetite at any time. If you feel the stock you're holding is high risk, you can get out of it quickly. Okay, if you want to invest in another stock to lower your entire risk, you can do that as well. Because you have an active financial market, you're able to manage your risk fairly quickly. Finally, reduction of transaction cost. Because there are so many buyers and sellers in one platform, you don't have to go behind and find buyers. The time cost and the cost involved for you to find a buyer or seller is reduced when there is a proper financial market. Okay, that facilitate or reduces the cost involved in contracting. Okay, so these are the functions of financial markets. Furthermore, we look into how financial markets developed. Early on, very old, did we have share markets and debt markets? No. It started small. Think about money, started with barter system, right? Just like that, markets started informally or in a very unorganized manner, and then it moved to a more formalized space after you know uh, all the issues and the consequences that they had to face. For example, first it would have started through money lending, through brokers, through cheat to system. Are there regulators who are giving regulations for money lenders, the informal money lenders? No. Do you have central bank regulations when it comes to this informal system like cheat to system? No. Okay, these are unsystematic, no documents. Do you sign a KYC with the informal pawnbrokers? If you have your neighbor has money, you give them your gold and you borrow money. Do you sign in any agreements? No. Okay, that's how it started on an informal basis. But there were limitations in the informal market that led or created the need for markets to be formalized. What are the formalized market? The banking system with documentations, with formalities, with regulations. Why? So if someone is affected or facing a loss, there is regulatory measures that they could take to address such a loss. Okay, so it's from the informal that we move to a formalized space. But why did the people want, or what created the rise of formal markets is again liquidity, transparency, reliability, legal procedures that are involved when you have to settle disputes, investor protection, and lower transaction costs. Now, let's take one example. You need urgent money. Okay, you have gold, you give that gold to your neighbor and you get money. Let's say gold is now going at a rate of 1 pound is 100,000. But will your neighbor give the market price? They will say, no, look here, not good gold. I can only give 80,000. So not even the market price. So there itself, it's going to be, you're facing a liquidity issue. Why? You are finding it difficult to find someone to pledge your asset for. You only reach the one who was closest to you because of your urgency. Okay, you lose out on liquidity. If it's someone else, they could have offered you 90 or 100 itself, but here it's only 85. Okay, now is it transparent? Do you know, now I pledged the gold and got 85. Another person would have pledged gold from the same person and got 90. Okay, it's not transparent in an informal market. It's just one party trading. Okay, and think about, okay, in 1 month's time you borrowed the money, and then let's say you are going to give the money and get the gold, and now the gold you are getting is not your gold, it's a different jewelry. Can you fight? Is there any reliability that the pledged asset will come as it is? Reliability is questioned in an informal market. And if there is an issue like that, can you take legal action? Do you have any documentary evidence? No. So there is no any legal platform to act as well in informal market. So if there is no way to act legally, will the investor or the market participant be protected? No. Okay. Finally, transaction cost in an informal market is very, very high. Why? Because in an informal market, I have to do the business. I have to approach and find someone. Okay. So that's going to take time and cost. Okay. Due to these reasons, people preferred a more formal market. Think about a bank doing pawning business. Okay. The bank practically puts out the notice, okay, they accept 1 pound at this rate. Transparent. There is a standard rate that they go for. It's transparent. Other one is liquidity. You don't have to find, you don't have to wait until you have to find somebody else to pledge that asset. You can approach X bank, Y bank, E bank, any bank. Okay, they are all available closest to that you could approach for. Reliability. What do you mean by reliability? Because you will get your documentation that you pledge this, everything. And because you pledge it with a formalized bank governed by regulation, you are assured that your jewelry is at safekeeping. Okay, and in case there is any issues, there are always legal measures that you can take against the financial intermediary in case there is any unfair treatment. So that allows investor protection as well. Okay, finally, low transaction cost. Why? You don't have to wait for a long time. You don't have to, you yourself don't have to find another party. You know, okay, you approach this person, get the work done, get the money. Okay, so the time involved and the cost involved is very low. Due to these factors only, people moved away from an informal financial market to a more formal market. Okay, and then finally, even today, we have financial markets being continuously transformed or developed and changed. What are the reasons for these financial markets to go through such change? The most important one is technology. Whenever there are technology improvements, we know financial markets also undergo this change. Very good example, Bitcoins. Okay, how virtual currency has changed our financial market. Then you have deregulation. What do you mean by deregulation? Regulatory measures are eased so that they could work more easily. Okay, without tightening certain market participants with regulations, you are easing it out more like a democratic phase where they can act based on principles. Okay, because of that, the institutions have more freedom to act, more freedom to put out innovative products and whatnot. This deregulation has created something called liberalization, has resulted in liberalization. What is liberalization? You allow foreign companies to enter our country, enter our market space. This creates, now let's say, a development that happened in US. We are able to benefit from it when that entity comes to our country as well. When they open up a branch, new services, new standards of services are created, which the local companies have to match. Okay. Finally, deregulation and liberalization creates or makes us more closer, creating the globalization impact. A development that happened in US will definitely find its way to Sri Lanka. Think about the real estate investment trust that was introduced to Sri Lanka last year. It's something that was introduced in US in 1960s. Okay, even though delayed, but there is the change flows to the financial markets. Okay, so due to these factors, financial markets are ever changing and evolving even as we speak. So us as financial professionals can't just learn the subject, close the book, pass the exam and move on. We have to be aware about the market occurrences and relate such occurrences to our decision making as well. Okay, so with that, we wind up our very first lecture for this subject. Next week, our focus is going to be on classification of financial markets. In detail, we will discuss what types that are available. I hope I was clear to you today. Then again, next week, next Saturday, we'll again meet. And if you have any doubts, I will share my email address here. I won't be starting the questions this week as well. Let 3 lectures move on and let's start after that. So we have more areas to test on. Whenever you have any questions, drop in a mail to that, email to that. I will look and respond. Have a good weekend. Okay, let's meet again next week. Thank you so much for listening.